Hi there, welcome to Kneppy Invest and welcome to March for 2025. I am doing my final shift for the next year tonight. My final shift was supposed to be last Monday night, and since then I've done one emergency shift, one overtime shift. The emergency shift was last Thursday. The overtime shift was Saturday night, and then I was texted this morning about the possibility of me doing another emergency shift tonight because of an illness. And I said, oh, it's fine, on the proviso that this will be my last shift for the next year. And then I got a text at about midday saying the person who originally called in sick is no longer sick and they can do the shift. But because we already organised an emergency shift, I'm still doing it. I'm still doing it. The management have decided. So this will be my final shift for the next year. And to be honest with you, I'm fine with doing it. I don't mind working night shifts. I just want to have leave or get into my leave. And so hopefully my leave officially, well, actually, technically my leave officially doesn't start until next Monday, but I want tonight to be my final shift. Anyway, a fairly interesting day on the market today. Not as bad as I thought it was going to be. I'll be honest with you. I thought we'll be down by over 1%. Some of the indices were down. Small caps down 1.74%. Definitely expected that. I think there is a bit of a rotation from the perceived more risky assets into the less risky assets. We started to see this a few weeks ago, and we're really seeing that now. I'm surprised any company is up today. We saw like CBA up 0.4%. I don't know why, because even though it might be perceived as a less risky stock, if we do go into a recession or even depression, now some people are talking about depression. You don't want to be in the banks. You do not want to be in the banks. They are highly cyclical. So I think that's what's happening now. We are seeing a rotation. People are getting out of risky assets or risky stocks and moving their money into less risky stocks. That's why small caps down fairly big, not only in Australia, but also United States. And that's why the XGO only down 0.58% on a day or a session when probably it should be down a little bit more. Now, I'll talk about why our market and the Wall Street had a bit of a hissy fit overnight. I'll talk about that in a second. But before that, what happened on the market today? We'll do that. ASX Today, looking at the best and worst performing sectors, indices, and also companies. Not much to talk about when we're talking about individual companies. Now, I do have a top 5 stocks of the day. And to be honest with you, not much to talk about. Apart from really the top stock of the day, and by the way, no standalone stock or top stock of the day video today. I've decided that. But I do or am intrigued to see what's happening with this one REIT called, what's it called? Healthco and Wellness REIT. That's also an intriguing story that I did read this morning. The other 4 companies, just a big meh. And then we'll have a look at a few of the comments if I have a bit of time. Okay. So what caused a bit of a hissy fit on the Wall Street overnight? Now, I did actually watch a few videos in regards to this. I'm not sure if I completely agree with them, because if you have a look at the 1-minute chart for the NASDAQ, now there was a bit of a sell-off around about 5:30, 6 o'clock our time, but you can't see any dramatic sell-off. In fact, unless they're talking about right here, unless they're talking about midday or midnight, just after midnight, the market opened. In fact, the market opened high. The market opened higher for the day. So maybe that's what they're talking about. Anyway, so the theory, and maybe this is not theory, Donald Trump did have a press conference today. And during the press conference, you can see in a lot of the stations or channels, they had the Dow Jones or the S&P 500, how that was performing in the bottom right. And during the press conference, you just see that just drop like a rock. And it's in regards to tariffs. So a lot of people were thinking that his threat of tariffs on like China, not China, but particularly Mexico and Canada were just that, threats. And the reason they were thinking it's just threats is because, well, hello, history shows us that broad tariffs are not a good thing. In fact, broad tariffs can be and have been catastrophic in the past. So this is a concern when we see countries implement broad tariffs. We haven't seen it for 90 years. Last time we saw broad tariffs was back in 1930, United States, Smoot-Hawley Tariff Act, and it was catastrophic. In fact, if you go to, say, the Great Depression, I saw this quite a few months ago because I was just looking at the Great Depression, doing a little bit of research, and just down below the origins, the first section is the Smoot-Hawley Act and the breakdown of international trade. And what they didn't realize back then, when they implemented all these tariffs, broad tariffs on imported goods, they didn't realize that, other countries would retaliate. They didn't realize that. They didn't think that was going to happen, and it happened. And it's going to happen here again. We've already seen some really interesting videos from Canada. The Ontario Premier is going to hit really back hard, particularly when it comes to alcohol. $1 billion worth of alcohol, American alcohol, like Kentucky bourbon, whiskey, whatever, is bought by Canadians. And here's the interesting thing. I think the Canadians are going to react way more negatively to American goods than what the Americans are going to do to Canadians, because the Americans are the instigators here. They're the aggressors, and definitely getting that vibe that I think this is going to really harm the American economy. And that is what a lot of economists are thinking as well. Anyway, Smoot-Hawley Act, have a read of that. If you've ever watched Ferris Bueller's Day Off, there was a really good scene about Smoot-Hawley, and, honestly, yeah, it's pretty boring, but very important. In fact, in this little section, it's mentioned here, in the popular view, the Smoot-Hawley tariff was one of the leading causes of the Depression. I'm not sure I would absolutely believe that. It didn't cause the Great Depression, but it made it really worse. And according to the US Senate website, the Smoot-Hawley Tariff Act is among the most catastrophic acts in congressional history. Now, I think, and this is just me going back in my memories, I have a feeling, and I'm going to verify that tonight, I should read about this. I have a feeling before this Smoot-Hawley Tariff Act, tariffs were something that was decided about by the Senate, that sort of thing. And then after the disastrous Smoot-Hawley tariff, they decided to put the tariffs in control of the president. And in my opinion, and this is just my opinion, one of the reasons, maybe the reason why Trump absolutely loves tariffs is because it's the one lever he has without going back to Senate. He doesn't need approval from the Senate. It's the one lever he has. And because it's the one lever he has, he absolutely loves tariffs, even though history shows, facts show, tariffs are bad. So at this point in time, this is, again, just my opinion, the possibility of a recession, some people are now saying depression, it has increased significantly in the last 24 hours because of his press conference. That's why the market tanked. And I'd say it's now 20%, 25% we go into recession within the next year. And the chance of a depression, probably 5%. That's all because of tariffs. Tariffs are evil, they're bad. And when I say that, I'm meaning broad tariffs. And that's exactly what Trump's doing. Broad tariffs, they're bad. I think focused tariffs, individual tariffs are okay, but broad tariffs are really, really bad. So I'm going to have a read and just verify that's true, that tariffs used to be under the control of the Senate. They used to decide, and now it's under control of the president. And that makes sense why Trump absolutely loves tariffs. Anyway, that's what I talk about when it comes to why there was a bit of a hissy fit on the American markets overnight. And since I will be up tonight, we can see how the market reacts. Wouldn't be surprised to see a bounce, but the market's starting to look a little bit dodgy. Not absolutely dodgy, but we don't want to see the NASDAQ fall much further from where it is now. It's starting to turn. So it doesn't look quite as bad as what we saw back in August, but starting to turn, possibly. Not that far off from all-time highs, by the way. So this could be just a short-term hissy fit. Okay, onto the market today. We did see a bit of a rally, interesting enough. So the markets actually, or the indices did rise through the day. And I'm surprised the ASX 20 or ASX 200 only down 0.58%. And that was because of the banks. Oh, healthcare as well. Oh, CSL. CSL was up today, 1%. And I think that also, so I wouldn't say confirms, there has been rotation from more risky assets into less risky assets. That doesn't confirm it, but I have seen this playing out over the past few weeks. This has been happening for a while. Energy had a bad day. Uranium and oil, pretty bad news there. I think uranium was because of a potential deal with Ukraine and has to do with uranium or something. And oil, OPEC has come out with something to do with increasing supply of oil. And the other thing, if we go into a recession, there's going to be less demand of oil. And if they increase the supply of oil, guess what happens? Demand supply means price of oil goes down. In fact, OPEC won't want that, mostly. Gold had a pretty good day. Flight to safety, maybe up 0.33%. And small caps had a pretty bad day as well, which again supports my thinking there's no rotation out of more risky into less risky. Perceived more and perceived less. Okay, ASX 20, we'll have a quick look at this. Down 0.37%, and I'm assuming some of the banks were up. Let's have a look. Well, ANZ's not. So 5 companies up, and those companies, REA, Transurban, CSL up 1%, CBA and Westpac both up between 0.2 and 0.4. Funny enough, ANZ down 0.47 and NAB down 0.76. What's going on there? Maybe, I don't know. I have no idea. Anyway, I'm not going to talk about why, if we do go into a recession or depression, why the banks are not the companies you want to be holding onto. Banks are highly cyclical, highly high. In fact, let's have a look at CBA. And the last real recession, well, actually, we didn't go in recession then, but the last time the world went into, we'll say, a worldwide recession was back in the GFC. And if we go back then, CBA dropped from $60 down to 24. Yep, down to 24. So it halved. So that could happen again. And if it did halve, we'll see CPA at, what's it now? It is at, come on, it is $157. So that means the price of CBA would be about $78. Would I buy CBA at 78? Well, maybe. It wouldn't be really good value at that price, though. If it got down to like 60, yeah, I think 60 would be good. Okay. That's all I really want to talk about when it comes to the ASX today. Let's have a look at the top gainers. I'll be honest with you, nothing much to talk about here. Ecograf I want to talk about. Yeah, there's nothing here I really want to talk about. There are only 2 companies here that I might discuss or might have wanted to discuss. Ecograf and Infocus Group, they're both here. They're both here because I just mentioned it, but they're the only companies that release something interesting today. The rest of the companies, I think, are just up on noise. I'll call it noise at this point in time. If we have a look at top gainers by market cap, some interesting companies here. Spartan Resources up 6.34%. Not sure what's going on there. I'm pretty sure it's a gold exploring company. They didn't release anything. I did actually have a check. I saw the share price was up. Didn't have a check, and the chart has been quite volatile, but in fact, I'd say there's not much trend right now. We've just had a moving average crossover, 2 in fact, in the last few days, and that is sort of hinting that the share price is now starting to go sideways. No trend in the share price. Other than that, nothing much here of massive note, and so I think we can move on to the top losers. So more interesting things here. Not in the list of top losers by percentage change, because there's many companies I've never heard of. Critica, Actinogen down 20%. Someone did ask me about this company the other day, and the chart looked interesting. Maybe not anymore. I don't think the company released anything today. And yeah, chart was looking interesting. Yeah, share price down 20% for some reason. And this is why I thought they didn't release anything, because I checked and they didn't release anything. Last time they released something was the 24th of February. So you might refer to this as noise. Maybe they're getting out of Actinogen because they're fearful of what's going to happen in the next year or so. Anyway, so let's go back to the top losers. And it's just a couple of crypto innovators, ETFs, beta shares, Ethereum. So after crypto had a really good day, a bad day. So massive volatility in crypto right now. A few interesting companies that I like. Soup Holdings down to 14 cents. That's looking interesting based off valuation. MoneyMe might be moving towards a sell. Take profits and run. Anyway, that could be an interesting play, just getting out of the less or the more risky assets, particularly companies like MoneyMe. Now let's have a look at top losers by market cap. Mesoblast down 8.37% on nothing. on nothing. So again, this also confirms that I think there is a rotation from perceived more risky into less risky. I'm pretty sure that nothing. So this could also be a sell for me. It's below 250. Yep, this could be a sell for me. In fact, it'll be a small loss. But again, my trading is all about protecting my capital. Anyway, one company I do want to talk about is Healthco, Healthcare and Wellness. They did release something that was interesting enough for me to talk about. And also Imricor Medical Systems down 10.44%. The rest here is just, a bit of, wouldn't say noise. Some of these aren't noise, like the Bitcoin ETFs. They're just down because really bad day for crypto. When I say bad day, I mean a bad day. So Bitcoin down at 84,000. So it was down, what was it down? 8.61%. Ethereum probably down over 10%. Yeah, Ethereum down 14.7%. So after the really good day, now a really bad day for crypto. Okay, so let's move our attention to the top 5, starting with Spartan Resources, which I've already talked about, haven't I? I've already looked at this one. So I shouldn't have talked about this company previously. So Spartan Resources, that's the chart. I've already mentioned it's not really trending right now. The company hasn't really released anything lately. Corporate presentation on the 10th of February. No results there. I'm pretty sure this company is still in exploration. And the way you confirm that is if you just go to the most recent Appendix 5B, released on 30th of January. Does this company have any receipts? And since I am talking about this company in the top 5, this is the only thing I have to talk about because we've already looked at the chart. So all you have to do is go to the cash flow and no receipts. In fact, not a lot of spending, which is surprising in operations. So they probably put exploration in in investing activities. $9.9 million spent in exploration and evaluation. Now, sometimes you can get a hint if a company is near production just by their first few pages, and they're just talking about exploration. And I'm not getting a hint that they're close to production. Now, that might not be true, but looks like they agree with Phoenix Resources. Anyway, to divest something. Anyway, so we've already had a look at the chart for Spartan. Let's go back to that, even though we've already looked at it. And again, no particular trend right here for this company after a pretty good trend. So it does look like the trend has come to or is coming to an end. Anyway, Spartan Resources. Talked about this company twice today. On to a company called Infocus Group. Share price up 11.76%. They secured 1.5 million stablecoin payments project. Congratulations, Infocus Group. You've released something pretty good today. Anyway, so I don't know anything about stablecoin. Is it that coin that has no volatility? Yeah, exactly true, because it's got the word stable in it. Type of crypto asset designed to maintain a stable value relative to a specific unit of account or store of value, such as an actual currency. So stable coin, and I suppose they want to use stable coin as a means of transactions. And I think that's what this announcement is, I think, because I just mentioned here, Infocus Group is a data analytics and software solutions company. And this is a service agreement with GBO Assets, an entity domiciled in the Seychelles. Infocus will be applying its expansive data analytics and software engineering capabilities to develop the project, which is a cross-border stablecoin-based payment platform. There you go, a stablecoin-based payment platform. So those who want to use stablecoin for their transactions, maybe this is the future. Let's have a look at the chart for Infocus. Actually, before we have a look at the chart, I haven't taken an in-depth look at this company. So what I want to do is just have a look at the most recent. I don't know why I put the T code back in. I'm not going to look at their Appendix 4D. I'm just going to have a look at the most recent Appendix 4C because it's smaller. Yeah. And I just want to see how good the financials are for this company. So receipts to customers, 791,000 for the first 6 months, 1.2 million. And they are burning through not a lot of cash, but they did burn through about $1 million in cash, not including government grants and tax incentives. Cash on hand is fairly low at 351,000. They did a capital raising. In fact, it looks like they all decreased their loans, their borrowings. They have a little bit of borrowings, but it looks like they are or do need a bit of cash. So have they done a capital raising? No, instead they're doing acquisitions. There you go. So let's have a look at the chart for Infocus. And does this chart look interesting? And the answer to that is no. Now, fun enough, a bit of selling today. So the market did sell off. Share price got as high as 2.6 cents and closed at 1.9 cents. So even though this does seem like a good announcement, has been a bit of selling, which is understandable when you look at the chart. Hopefully you know why there's been a bit of selling just by looking at the chart. Now, in saying that, I think there is indications that the share price, if it keeps going sideways, that it's in the consolidation phase, and then eventually all those shareholders who bought at high prices and want to sell will have sold out. That's what we're seeing today. We're seeing share price rally. It has some shareholders have seen it as an opportunity to get out of this dog stock, which it might be. This company might be a dog stock, and so they're out now. So we have some new investors in, some new holders, and if the share price keeps on going sideways, some of those holders might get out because they're bored if the share price just goes sideways. But eventually, you might see more shareholders more willing to hold for the longer term, and then eventually the share price can break out, and you have less resistance because all those shareholders who bought at high prices in the past are now out, and in their place you have these shareholders who bought at where the share price might be right now when it breaks out, and they're more willing to see it right higher. They're more willing to see the share price go higher. That's very important because if you see you're holding in a company in the red, you're more likely to sell if you see the share price pop up. If you're in the green and you see the share price rise, you're actually less likely to sell. Okay, let's turn our attention to company coming in number 3. We have a company called Ecograf. I suppose this is share price up 19.1% on being granted a special mining license in Panko Life of Mine, and this is from the Tanzanian government. So a bit of a sovereign risk there. Pretty sure it's Tanzania. Yep, Tanzania, the United Republic of Tanzania. So granted for 25 years, mining area, 18.9 square kilometres. This provides certainty and is a key regulatory permit required in respect of the Epanco financing process. So I don't know anything else about this company, but it looks like the market likes this particular announcement. It does sound pretty good. I'm assuming this is, what is it? What are they mining? They mentioned all there. High purity graphite products for lithium ion battery and advanced manufacturing markets. Okay, I'm less interested in this because it's graphite. Okay, so let's have a look at the chart for Ecograf. Actually, it makes sense, Ecograf, graphite. Duh, it's just that graph was spelled with an F. Yeah, that confused me. Now, saying all that, chart doesn't look half bad, huh? Now, again, just like what was the other company, Infocus, we have seen a bit of selling today. Share price did get to a high of 15.5 cents and it closed at 12.5 cents. So not the best looking one-day candlestick, but overall, the chart looks okay. We have seen a potential breakout. The last time share price was this high was back in June last year. So we're talking about a long-term high, but still there will be a bit of resistance because the share price of this company has dropped a lot over the last few years. Yes, so there's going to be a lot of resistance moving forward for Ecograf, but potentially a lot of those shareholders who bought a few years ago are already out, hopefully. But anyway, so and the other thing is volume. Look at the volume coming through today. Pretty big volume. So it's Ecograf. Coming in number 2, we have Imricor Medical. Share price down 10.44%. This could be a little bit of noise because the announcement they did release, submission of second module to FDA for PMA products, doesn't sound negative. I'll give you that. It does not sound negative, but it did send the share price down. So I just decided to include this in the top 5. Yeah, so I don't know how this could be perceived as negative, but share price is down. In fact, they said here, Steve Wedden, the CEO, we had set an internal deadline for the manufacturing module to be submitted by the end of February, and the team came through again, keeping us on track. Okay, so for some reason, share price is down. So let's have a look at the chart for Imricor. So this is probably, coming in number 2 is probably a little bit too high. In fact, maybe this shouldn't be in the top 5 at all. And the chart looks spectacular. I would say the share price is down not because of this announcement, just because, again, I think this is a more risk or perceived more risky asset. And I think maybe some shareholders just getting out, taking their profits, because share price has been on a pretty nice run since October. Share price has, more than doubled. So a pretty nice looking chart for Imricor. And I think this is just, I think this is just people protecting their capital. Something I do. And we all should do. And finally, coming in at number 1 is Healthco, Healthcare and Wellness REIT. Maybe we should just call it Healthco. Share price down 7.77%, which is quite unusual for a REIT. Why? Healthscope update. They're not getting any rent from Healthscope. Healthscope used to be on the ASX. They were bought by, in fact, I'm pretty sure they will tell us in this announcement. They were bought out about 5-6 years ago. I'm pretty sure it was pre-COVID-19. They listed maybe 5 years previous to that. Hospital, so not a high quality one, if I remember correctly, but I could be mistaken. So they were bought out. So I just remember reading this morning and went, Healthscope, they used to be on the ASX. Yes. Anyway, so they don't mention this, who owns Healthscope here, that I can see. Healthscope, if you just Google Healthscope, ASX, here we go. And so I'm just going to go to, not ASX. You know what I want? I want Wikipedia. There we go. Private healthcare provider with 41 hospitals. Okay, they listed in July 2014 on the ASX. And, Brookfield bought Healthscope in June 2019. There you go. So they were on the ASX for about 5 years. It seems like some private equity have been holding that company otherwise. Anyway, so Healthscope might be in trouble. I don't know. Just based off this, that Healthco and unlisted healthcare fund UHF today issued breach notices to Healthscope because they failed to pay rent. They failed to pay rent due for March 2025. Part payment of the rent has been received. So what's going on with Healthscope? Could it be trouble with the company, or could be just someone someone didn't put an alarm in their clock or their watch or their, phone? Maybe that's what happened. Maybe it was just a mistake. Maybe Healthscope is fine. Who knows? But Healthco also put out a bit of an update to their guidance saying they're withdrawing. So their guidance of 8.4 cents DPU, which is distribution per unit, and FFO, which is funds from operations, has been withdrawn pending resolution of the Healthscope tenancies. They also mentioned that they want to throw out Healthscope from these hospitals or something like that. I don't know how that's going to work. Anyway, so let's have a look at the chart for HCW. I would think this is one of the more defensive REITs because it's hospitals, but here you go. Doesn't always work out like that. So let's have a look at the chart. Oh, in fact, the chart looks pretty ugly. This is a bit of a surprise. I did not expect the chart to look like this. So maybe the market is not that enthused about this particular REIT. The price of this particular REIT, Healthco, has dropped to long-term lows today. Oh, and look at that chart. This is an ugly chart. This is the weekly chart going back to 2021. The price of this particular REIT has dropped from like 225 down to 88 cents. This is not a good chart for a REIT at all. So maybe the worst is in. Maybe this is the bottom, but we just don't know. Just don't know. Okay, that's all I'm going to have for today's video. Actually, no, should I do a few comments? Yeah, let's do a few comments. Ramar Garwal, can retail investors form an association to change management in regards to Star Entertainment Group? You could try to pressure. I think individually, yes, you will not be able to change. Can you form an association? I'm pretty sure there's already shareholder associations out there for the ASX. Let's have a look. There's one called the ASA, I'm pretty sure. ASA, shareholder, not the Sonograph Association, shareholder. I'm pretty sure there are a few. Yeah, Australian Shareholders Association is the voice of retail shareholders, educating investors and standing up for shareholder rights. So maybe, just maybe, you want to join Australian Shareholders Association. So maybe you do get more power as a group if you do join up. So individually, you have no power at all. They're not going to look at you. They're not going to listen to you. The same sort of thing when it comes to voting. Why, in my opinion, the country, probably Australia, United States, many countries are ruled by the rich. Why, in my opinion, are countries ruled by the rich? It's because their vote is more important. Why is their vote more important? Because the money. They get funds. The politicians get funds from the rich. You could give your funds or some funds to your favoured political party. It's not going to be a lot compared to the rich. So the politicians are going to listen to the rich way more often, which is why Trump surrounds himself with rich people, because they give him money. So I believe it might be cynical, but I believe our country is run by the rich of this country, the rich people of Australia. They run this country. Politicians don't. I know that's cynical, but that's what's happened when you allow people, individuals and corporations to provide donations. Because politicians rely on donations, and whoever's giving the most donations, they're going to listen to. They're going to listen to you or me because we are unimportant to them. As a group, we could be important. Anyway, so I'm sorry to be so cynical. So thank you for that, Ramagarawa. Well, Rick Thellian has mentioned here that One Steel, or Whyalla, whatever it's called, the only producer of a particular steel process in Australia. So it's a national importance in South Australia, which probably makes sense why the government, I think it's South Australian government, is wanting to protect that particular company. Jerry Shen says, second-year uni student here, what are your thoughts on listed real estate private credit funds like QRI or MXT just for the purpose to get higher returns than savings? I'm considering this alongside my share portfolio. Keep up the great vids. How would I answer this? I think it all depends on your risk profile. Now, I will say this. This is what I'm going to say. I don't have any thoughts on QRI. Or let's have a look at QRI. What is their distribution or dividend? Actually, let's have a look. So according to CommSec, their dividend yield is 8.7%. It's pretty nice. P ratio 11.45. What's the NRMA? Let's have a look at the chart. So do you really need any sort of income from stocks you own? Do you need, I think the question is, do you need income from stocks you own? So just by looking at this Qualitas Real Estate Income Fund, all you're getting is income. And the reason I say that is because if you have a look at the chart, take away COVID-19, share price of this has been going sideways. So all you're getting from this, the only return you're getting from this is the income. Now, I'm going to tell you what I believe the focus should be for investors. So there are two things you should be focused on: protecting your capital and growing your capital. Now, what is more important among those two, I think, depends on your individual circumstance. So, for instance, if you just start investing, growing your capital is way more important than you're protecting your capital. But if you're heading towards retirement, protecting your capital is way more important than growing your capital. You don't want to see your capital drop 50% in 1 year, leading into retirement. That would be the worst thing ever. But I think it all depends on what stage of life you're in. And it also depends on individual circumstances. So if you just started investing, relying on income or thinking this is good because you're getting income may not be the best sort of investment. The thing you might be wanting to invest in is those companies that are growing their capital. You might see your capital grow or double, quadruple, tenfold increase, 10-bagger, 100-bagger over the next 10, 20, 30 years. So I'd say this sort of instrument is probably good for retirees who are wanting an income. That's just my opinion. So higher return than savings. Okay, so this is another interesting thing. Another thing I'm going to say here. It also depends on what you have planned. So if you're saving to buy a house, the question becomes, are you willing to risk that deposit? I would be very wary of having a deposit for a house in stocks because, again, you could see the stock market pull back significantly and that $200,000 deposit might turn into $100,000. You just don't know when the correction might come. So would I rather put my deposit into that? Well, we just saw during COVID-19 that the price of this particular instrument fell a fair bit. So I'm not sure if this would be immune from any significant correction in the stock market if we do go into recession or depression. So in that sort of situation, I probably will prefer to have my money in cash. So it all depends on what your plans are for the future. If you got a lot of money and you don't want to put into like a banking account because savings are really low, and you're not concerned about any sort of decrease in the market, yeah, maybe these are pretty good instruments for you. Again, the other thing I should mention is I am not a financial advisor, so get some financial help if you want to get more information on these sort of things. So I plead with you, don't listen to me at all. That is what I would do. I wouldn't rely on these for income. No, I wouldn't rely on these if I was a new investor just because they give income. But if you just needed income, then maybe these are good instruments. So hopefully I'm clear. I'm going to end it there just because I don't want to. Anyway, just because I can. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.